Welcome to Markets Plus, where leading experts from across BMO discuss factors shaping the markets, economy, industry sectors, and much more. Visit bmocm.com/markets plus for more episodes.
An escalating conflict in the Middle East risks a prolonged period of elevated energy prices, which threatens to have material impacts well beyond energy, on markets, and on the economy. Accordingly, on Monday, March 9th, we sat down with two experts to shed light on what they expect in the weeks and months ahead. I'm Camilla Sutton, Head of Equity Research in Canada and the UK. And today we are joined by Doug Porter, Chief Economist at BMO, and Randy Ollenberger, Oil and Gas Equity Analyst at BMO Capital Markets. Thank you both for joining us today. Randy, why don't we kick it off with you? Can you walk us through what has happened in the Middle East over the last few weeks and how energy, commodities, and energy equities have reacted?
Yeah, thanks, Camilla. I mean, obviously, there's a lot of headlines and media coverage of the U.S.-Israel war with Iran and what's happening with all of the destruction that's going on there. But from an oil market perspective, fundamentally what's happened is we have stopped moving about 20% of global oil supply out of the Persian Gulf to world markets and about 20% of global LNG supply to world markets. And predictably, that's had a big impact on oil prices. The initial impact was actually, I think, quite muted. And I think what that reflected is a view or an expectation that this conflict would be short-lived. It doesn't appear to be the case. And in fact, the level of strikes and the intensity of those strikes is increasing. One of the big risks here, of course, is that Iran starts to lash out at some of its Persian Gulf neighbors and damage oil infrastructure or natural gas infrastructure. And that would have more lasting impacts on the market. So what we're seeing right now is oil prices trading near $100 a barrel, reflecting a view that perhaps this thing will end soon and we won't have any major destruction of oil facilities. Again, that's not guaranteed. We could see some facilities damaged here that would have more lasting effects. And if we don't start deliveries through the Strait of Hormuz, we're really going to start drawing down global oil and product inventories, and that will create quite a problem. The G7 ministers are musing about the possibility of a strategic release of reserves, but at maximum, they can only release about a third of the production that was coming out of the Persian Gulf here. So we see the possibility of oil prices moving materially higher from here, perhaps even through the $150 level. Natural gas, it's very similar. We're looking at 20% of global LNG exports being disrupted. We've already seen gas prices spike up in Europe. We think they could move higher, and that could pull Asian markets higher, and it could also ultimately pull Henry Hub prices higher in the United States. So as we sit here today, the risk on commodities is clearly still biased to the upside. Oil and gas equities haven't participated fully in this rally, and that's logical. We're not going to start discounting in $100 oil prices into permanent valuations. But it's important to recognize here that if this is more money in the bank for these companies, that means better balance sheets, and that's a real permanent improvement in underlying equity value. And we're also expecting to see that surplus cash move to shareholders. So net, this is very positive for the sector, even if the conflict doesn't last over a prolonged period of time.
Doug, let's get you in here. Can we move to the big picture? How does this kind of oil shock impact the economy in both the US and Canada, and maybe even weave in a bit of Europe as well?
Yeah, sure thing. Thanks, Camilla. So clearly, a true oil shock is not good news for the global economy. It's as simple as that. We know it's both negative for growth, and certainly it tends to push up inflation almost everywhere. I would say it's a little bit more straightforward on the inflation front. In some ways, it's quite mechanical. There's been reams of research on this in terms of exactly how much, a certain percentage in oil prices drives up inflation. The trick is, what do you assume in terms of oil prices? Like, how long does this shock last? And the way we try to manage this is we look at a variety of scenarios, some which include a near-term spike as high as $150 a barrel, and then, different possibilities in terms of how quickly they come down, and then we put different weights on those scenarios. I will tell you, just in the last week, we've had to somewhat readjust those weights because clearly some of the more optimistic scenarios are less likely and some of the more pessimistic scenarios are a little bit more likely. I would say that the kind of number I would throw out there right now will sound quite conservative, given the fact that we're looking at triple-digit oil at the moment. But based on our weights, we're still looking at roughly a 20% rise in average prices this year. So if before we were looking at an average oil price of about $60 a barrel, we'd be looking at something closer to 72 on average. Again, that takes into account a move above $100 in the near term. That alone would push up inflation in both Canada and the US by a little bit more than a half a point this year. Doesn't sound like that big of a deal, but a half a point or a bit more than that can make quite a difference, because instead of looking at something in the mid to low 2% range, we're looking at inflation averaging a bit more than 3% in Canada and the US potentially. And that is out of the comfort zone of the central banks. And of course, there are some scenarios where it could be much higher than that. One example I would give is if you look back at 2022, oil prices in that episode went from an average in 2021 of about $68 a barrel, not that different from this episode, to an average of $95 a barrel in 2022. And that absolutely spiked inflation and was one of the big reasons why central banks had to raise rates as much as they did in 22. But in terms of the growth impact, while it's very mechanical on inflation, it's a little more nuanced on the growth side. It is negative for global growth. It's not necessarily that negative for North America, and there's a couple reasons. First of all, the world has changed in the last 20 or 30 or 40 years. The economies are simply less energy intensive than they would have been back in the 70s, 80s, or even the 1990s. And as well, the U.S. is now an oil exporter, whereas it was a large importer as recently as 20 or 30 years ago. So it's not as negative for the U.S. economy, and Canada is more of an exporter than it was 20 or 30 years ago. It will chip away at growth, we believe, but provided that prices don't stay above $100 for long, we think the net growth impact will be relatively modest, assuming oil prices do eventually retreat through the second half of the year. But at the margin, it is negative, and certainly for the U.S. economy, we are looking at somewhat shaving our growth outlook for the U.S.
Randy, let's switch back to you here. What keeps oil well above 100? What pushes oil back down to the $60 or $70 range?
I alluded to earlier the fact that, the real risk here is damage to other infrastructure. So if we see some damage to infrastructure in Saudi Arabia, Iraq, UAE, Qatar, that's really what would keep oil prices elevated, because this is a region of the world that accounts for about 20% of global oil supply. And so if we have any damage there, we simply can't make that up. All the surplus capacity in the world is in those same countries. So, it's very difficult to envision a scenario where, for example, we lose 2 or 3 million barrels a day of Persian Gulf supply for a period of a year or so, where that could be made up. The U.S. simply can't respond that quickly, for example. I mean, you could dramatically increase the rig count in the United States, but it can take you 6 to 9 months to see that oil come to market. Canada, we're constrained by pipelines, so we can't move any more oil to the market. And if you look at the rest of the world, Brazil, Guyana, other places that have been growing, these projects take 5 to 10 years to come online. So the only place you can quickly get oil is from that surplus capacity. That surplus capacity is at risk right now. So that's what would keep oil prices above 100. What would bring oil prices back down again, of course, would be a resolution to this conflict. So if the United States and Iran reach some sort of agreement, that allows deliveries through the Strait of Hormuz again. We may lose some production at the margin, but there is spare capacity, as I said, within Saudi Arabia, within the UAE, and that would calm oil markets down. And that's probably something that would bring oil prices back down to the $70 level. I don't know if we go back down to the low 60s again, where we were before the conflict, just because, again, risks will be more elevated. But effectively, what we need is peace.
You mentioned there the Strait of Hormuz. You did some work in your weekly this week in terms of the tankers that are building up there. Can you walk us through some of that?
Yeah, so the Strait of Hormuz is only 21 miles wide at its narrowest point, and the shipping lanes in each direction are actually only 2 miles wide. So this is a very important strategic choke point for the global oil market. As I mentioned, 20% of the global oil supply moves through that region. Iran has threatened to strike any tankers moving through that region. And so what we've been seeing is a buildup of tankers basically trapped in the Persian Gulf that have either loaded oil or are waiting to load oil. And then outside of the Strait of Hormuz, we've got a buildup of empty tankers waiting to get in. That's forcing oil into storage tanks in the Persian Gulf, and those storage tanks are starting to reach capacity. And so what we've heard over the course of this past weekend is that countries like Iraq, Qatar, Kuwait, and Saudi Arabia are reducing production because they can't put the oil on those tankers. The tankers are all essentially full. They need those empty tankers to come into the Persian Gulf. So we're seeing a big buildup of tankers in the Persian Gulf, that's really making it more difficult to actually move oil from other markets as well. So, for example, the G7 has a lot of oil in strategic storage, but if they agreed to release that oil, they would need to put it on tankers. Those tankers are trapped in the Persian Gulf.
And Doug, walk us through a little bit. With oil and natural gas prices higher and obviously volatile, is there anyone who benefits, and who's the one who faces the biggest squeeze?
In general, when we look at the economic outlook, we tend to think energy prices that are high and volatile or low and volatile are not good for the global economy in general. Essentially, what you want is stable, predictable energy prices. That's to the benefit of all economies. Of course, there are some winners from higher energy prices. If, for instance, if we look at it from a regional basis in Canada, it's quite clear that the energy producing provinces of the country do benefit. That's Alberta, Saskatchewan, and Newfoundland, and to a lesser extent, Manitoba. But it's quite clear that the other 6 provinces do not benefit. In fact, they are net losers from higher energy prices. And you can make more or less the same comment about the different regions of the US. I'd say if you were to spread it out more globally in terms of who really gets hurt by this, it's the large energy importers of the world, and that would be the Japan, Korea, and to a lesser extent China and the European Union that really suffer as a result of high energy prices. The winners in terms of nations are really the net energy exporters that can still actually export their energy. So in some ways, and it's all relative, but Canada does fare relatively well compared to others because our supply is not being disrupted. And that's actually being reflected in the currency. What we saw over the past week is the Canadian dollar was actually quietly one of the strongest currencies in the world. It actually rose slightly against the US dollar, which was rising against other currencies. And that does quietly reflect the fact that Canada is a bit of on balance a net winner, but it is regionally very focused. I will tell you Central Canada and British Columbia will not do well as a result of this spike.
And what about when it comes to things like the impact on food costs? So you've already mentioned that inflation is likely to go higher. How much of that going higher is based on just the energy itself versus things like fertilizer, not being able to plant the crops, and in turn food prices moving higher?
Yeah, that's definitely a second round effect, but it cannot be ignored. And, I went through that example earlier of what happened to oil prices in 2022 as a result of Russia's invasion of Ukraine. The oil price spike alone, you would have expected it to have added perhaps 1 to 1.5 percentage points to inflation in 22, and instead inflation went up by more than 3 percentage points that year, and that reflected some of the other effects. And of course, we had supply constraints that year as well. But it did make a bad situation for food prices worse. It did put pressure on other prices. Of course, oil is still the most important commodity in the world. It works its way through many different costs, packaging costs, transportation costs. And, I think some of the mechanical estimates of what energy prices do to inflation don't always take those second round impacts into effect. And so I do think the risk is, if we do have a sustained rise in oil prices, that it does go above and beyond just the direct impact that you're looking at in terms of the direct oil impact. So I would say if, for instance, if we did stay close to $100 a barrel, it could easily add 2 to 3 percentage points to headline inflation.
So that would be a drastic scenario. When you think about central banks and you think about the Fed and the Bank of Canada and even some of the European central banks, can you walk us through what will actually push them to change their current path?
So this is a tough spot for central banks. If you think of it in terms of the Fed's mandate, they try to keep employment high and inflation low, and this is a threat to both. There is not an easy answer for how the central banks should respond to it. Typically, their mantra is that they look through things like oil price spikes. In other words, they won't necessarily respond to it. But I can tell you initially how the market has responded is to dial down the amount of expected Fed rate cuts this year. And for the Bank of Canada, we've gone from assuming no move in the Bank of Canada this year to now the market's actually starting to lean to the possibility that the bank may have to raise interest rates this year. And that's definitely the case for Europe. There's now lots of talk that the ECB may actually have to raise interest rates as a result of this. The ECB responds a little bit differently than other central banks. It seems like they tend to care and are swayed much more by headline inflation. And I could actually see a scenario where the European Central Bank would raise rates, even though growth is under downward pressure from this. I suspect that this spike in oil would have to be sustained for quite a period of time before the central banks would actually be hiking rates. I think it would take a lot for the Bank of Canada to hike interest rates. Keep in mind, of course, Canada is still dealing with all the uncertainty around the U.S. MCA. The economy barely grew in the past year. That's a pretty tough environment to be raising rates, even if headline inflation does move up a lot. So our core view is that this probably locks in the Bank of Canada not moving on rates one way or t'other this year. We're still pretty comfortable with that. In terms of the Fed, I actually do think it does dial back the amount that the Fed will be able to cut rates this year. We had been calling for 3 Fed cuts through the second half of this year. That's looking a lot less likely. They're going to be challenged to even cut twice this year, even with that really weak employment report that we saw at the end of last week. This is a tough spot for the Fed. It's a real challenge to be cutting interest rates when headline inflation is ratcheting higher.
We're coming close to the end here, but I wanted to give both of you a chance just to sum it up. Maybe Randy, we'll start with you and then we'll move to Doug for the final words. What would you like to leave investors with?
Well, I think what I'd like to leave investors with is the thought here that the risks are still biased to the upside. We don't see any clear path to ending this conflict. This could drag on for a while. Even though there's a recognition that President Trump doesn't really want high oil prices, particularly heading into the midterm elections, there's no really easy resolution to this conflict. Both sides seem to be very entrenched. So at a minimum, even if this conflict were to end tomorrow, we're still looking at prices that are probably going to remain elevated for some time. And we don't think this conflict is ending tomorrow. And so really, we need to start thinking about the idea here that oil prices are going to remain perhaps around $100. Gas prices are going to be moving higher, particularly the international LNG market. And investors should start really thinking about what that means from a valuation perspective for oil and gas stocks. There's more cash available. More cash available means free cash flow yields are moving higher. That means share buybacks are moving higher. And that means balance sheets are getting even better. So we think there's still very good opportunities for investors in the oil and gas space, particularly for crude oil producers, but even on the refined side of things for refineries, integrated companies. We're seeing a lot of strength in crack spreads because the Persian Gulf is also a big exporter of refined petroleum products. So in a typical cycle like this, you would see investors go long producing stocks and short integrateds and refiners. This is an environment where both sectors do well.
Doug?
So I think the initial word of advice last week from many was that, geopolitics rarely make lasting impacts on the economy. Even conflicts, oftentimes the initial reaction is an overreaction. It's interesting. I would almost turn it on its head this time. It was almost as if investors were too relaxed this time, and we're reading too much into some of those events of the past that didn't have a lasting impact. Sometimes geopolitical events can have a serious, sustained impact on commodity markets, which then can have a sustained impact on the global economy. And, while I've often talked about 2022 and how oil prices did ratchet higher and stay high for a year, I would also harken back to the last time Iran really dominated the headlines, which was 1979-80. Take a look at that episode. Oil prices more than doubled in the space of a year, and they stayed high for a number of years, and that led to a sustained spike in inflation and much higher interest rates, which eventually led to a global recession. Now, I'm not saying that we're going to get a repeat of that this time, but I would be careful about downplaying this too. This is a very important event, and we have to really consider the possibility that oil prices and natural gas prices are going to stay higher for longer, and take that into account. So while I fully agree that investors should not overreact to the headlines, that doesn't mean you don't react whatsoever, because there is the very real possibility that we are looking at a scenario where oil prices do stay higher for longer, and that will have real world impacts on things like inflation, growth, and interest rates. And so I do think investors have to be nimble and don't just assume that things are going right back to where they were on February the 27th.
Randy and Doug, both of you have shared a tremendous amount of insights today. Thank you both for joining us. I think it was very helpful. That was BMO's Chief Economist, Doug Porter, and Equity Analyst, Randy Ollenberger. We are glad you were able to join us today for our discussion on the Middle East and markets.
Thanks for listening. You can follow this podcast on Apple Podcasts, Spotify, or your favorite podcast app. For more episodes, visit bmocm.com/marketsplus.
The views expressed here are those of the participants and may not necessarily represent those of BMO Capital Markets, its affiliates, or subsidiaries.
For BMO disclosures, please visit bmocm.com/podcast/disclaimer.